Hello students, today we are going to begin a new chapter in management accounting called cash flow statement. So today let us have a discussion about the theoretical aspects of cash flow statement. Cash flow statement is a report that depicts the changes in the cash position between the beginning and the end of the period. It is a statement which summarizes the sources from which cash payments are made during a particular period of time. It shows the various sources of cash inflow and the cash outflow during a period and explain the changes in the cash position of the business. So students, the cash flow statement is a report, it's a list that shows how much cash is received and how much cash is paid during a particular period of time. Preferably it is one financial year. In one financial year, you need to find out how much cash has come and how much cash has gone. But there are a lot of difference between the fund flow statement and the cash flow statement. In case of fund flow statement, the term fund means working capital. In case of cash flow statement, it is cash. In case of fund flow statement, it's called net current assets. So fund means cash, bank, debtor, stock, all put together. It's called net current assets. Whereas in case of cash flow statement, it is only cash in hand and cash at bank. So in case of cash flow statement, so debtors, stock, BR, all these does not constitute cash. So in case of cash flow statement, the term cash is only cash in hand and cash at bank. So that's a lot of difference between FFS and CFS. So thus cash flow statement is a report. It's not an account actually. It's a report, it's a statement, it's a table that shows the change in the cash position between the end of the period compared to that of the beginning of the period. Generally you see students, salaried class, beginning of the month they may have lot of cash in their hand. End of the month they may not have cash in their hand. In the same way, you try to find how much cash was there at the beginning of the financial year and at the end of the financial year of a particular firm. Thus, students, CFS will briefly explain you the cash payments and the cash receipts during the accounting year. So this statement will show you from where cash has come to where the cash has gone. It's called cash inflows and cash outflows. But you prepare the cash flow statement for a definite particular period of time. Generally, it is one accounting year. So, conclusion students, cash flow statement will briefly explain the cash position, how much was cash at the beginning and how much is the cash at the end. So, to conclude, cash flow statement will consider only three: cash in hand, cash at bank and bank overdraft. Only these three will be considered in cash flow statement. So the main difference between FFS and CFS is the term fund. The term fund in fund flow statement means net working capital. It can also be called as net current assets. How do you find the net current assets? CA minus CL. The term fund in cash flow statement means cash, bank and BOD. The applicability of cash flow statement has been defined under the Companies Act 2013. As per the definition in the Act, a financial statement includes the following: So any company for that matter, they are supposed to prepare 5 statements in their final accounts. One, the balance sheet. Second, profit and loss account, so-called income and expenditure account. Third, they have to prepare cash flow statement. Fourth, they have to prepare statement of changes in equity. And the fifth, they have to give an explanatory notes. So these 5 constitutes the final accounts of a company as per Companies Act of 2013. Thus, cash flow statements are to be prepared by all companies. But the Act also specifies a certain category of companies which are exempted from preparing the same. Generally, all companies may have to prepare a cash flow statement, but certain companies are exempted from preparing the cash flow statements. What are those companies? One person company is called OPC, small and dormant company. One person company means a company which has only single person as its member. A small company is a private company with a maximum paid up capital of 50 lakh and maximum turnover of 2 crores. So the capital should not be more than 50 lakh and the sales should not be more than 2 crore. Then it is called small company. A dormant company is an inactive company. Means the company is not active, it does not undertake any production activity, which is formed for some future projects or only to hold an asset and has no significant transactions. So dormant company is not so active, they don't involve in producing the goods, they only keep the assets as a custody and there will be no important material transaction like purchase, sales, etc. So these 3 companies are totally exempted from preparing cash flow statement. So the accounting standard have broadly classified the cash flow from 3 important activity. Students, the cash may come, the cash may go from any one of the 3 activities mentioned in the screen. So that means we can either receive the cash or make a payment of the cash either from these 3 activities. First we call operating activity, investment activity and financing activity. First, operating activity. It is called as revenue activity. The transaction that determines the net profit results in cash flow is cash from operating activity. Students, it is called as revenue activity. What is revenue? That is recurring in nature. Everyday transactions. This activity does not occur once. It occurs every time. Purchase of goods, sale of goods, receipt of income, payment of expenditures. All these are called revenue activities, day-to-day activities. From our regular day-to-day activities, we may receive cash, we may make payment of cash. That is called cash flow from operating activity. By undertaking business operation, we may get certain flow of cash. The transaction that determines the net profit results in cash flow is called cash from operating activity. Students, the transaction that results in profit or loss. What are those transactions that results in profit or loss? Sale of goods, purchase of goods, payment of expenditures, receipt of income. Simple, the trading and PL account. So we record all expenses in the debit side and all incomes in the credit side. From those entries, we derive net profit and that is called cash flow from operating activity. Example, cash payment for purchase of goods, cash received from sale of goods, cash paid towards expenses. Other example, cash received from incomes. So any cash received, any cash paid on operating activity, it's called cash flow from operating activities. Second one, students, it's called investing activities. These are the activities that results in purchase and sale of fixed assets and investments. Investing activity means committing the fund for fixed assets like purchase of land and building, sale of land and building, purchase of plant and machinery, purchase of furniture. So when you commit the fund, invest the fund in fixed asset, it is called investing activity. Example, cash received from sale of fixed asset, cash paid for purchase of fixed asset, cash paid for purchase of shares and debentures of another company, not our company, students. If it is our company shares, it is called financing activity. So third point talks about investing in another company. So A company will invest in the shares of B company. Then for A company, it is called as investment. Cash received from sale of shares of another company. These are called investments. Say A and B is called fixed asset, C and D is called investments. Third activity, students, called financing activity. It indicates the funds borrowed by the firm and the funds repaid by the firm. These are the activity that results in changes in the composition and size of the capital and the borrowings of the business. So it only affects the share capital and the long-term borrowings. So if you issue shares, if you redeem preference shares, if you issue new debentures or redeem the debentures, it results in financing activity. Simple. Loans taken, loans repaid. Shares issued, shares redeemed. So financing activity results in three. Number one, share capital. Number two, debenture. Number three, long-term loans. So these three are very important to run the business in terms of long-term finance. So these are the activities that results in changes in the composition and the size of the capital and the borrowings of the business. Example, cash received from issue of shares and debentures, cash received from loans raised, that is loans borrowed, cash paid for redemption of preference shares and debentures. So thus financing activity involves only three: share capital, debentures and loans. Okay students, with here let us stop the theoretical aspects. In the next session, part 2, we will discuss the next important topics. Let us have a glance of what we are going to discuss in the next class. To be remembered, we need to look into it's a format of cash flow statement, format of operating activities, format of investing activities, this format of financing activity. So all this we are going to discuss in the next class. Thank you.